My name is Kevin Wiley, and on behalf of the Tulane University Burke and Road Reports analyst team covering Iberia Bank Corporation, which includes Greg Cercelli, Hongmei Gao, Chengting Luo, and Rafael Suarez, it is my pleasure to present to you the Iberia Bank video report. Iberia Bank Corporation is listed on the NASDAQ exchange and trades using the ticker symbol IBKC. Our team is projecting a 12-month target price of $57, which led us to assign a market perform rating to the company, using the Burke and Road Reports guidelines. Iberia Bank Corporation is the holding company for Iberia Bank. The bank offers commercial and retail banking products, including commercial and mortgage products, treasury management, investment banking, and other financial services. The company is headquartered in Lafayette, Louisiana, and has total assets of $13.1 billion as of December 31st, 2012. Iberia Bank is considered a small cap firm, as its market cap is roughly $1.5 billion. This map shows Iberia Bank's locations as of May 2012. As you can see, Iberia Bank is most prominently located in Texas, Arkansas, Louisiana, Tennessee, Alabama, and Florida. The company has been able to expand its geographic footprint in recent years through acquisition, as well as through organic growth. Due to its acquisition strategy in recent years, the company is focusing on improving its efficiency by closing underperforming branches across all states. Profitability in the banking industry is correlated to a number of economic factors. These drivers include interest rates, government fiscal regulations, and the economic outlook. Profits of commercial banks primarily come from their net interest margin, which is the difference between a bank's total interest income and total interest expense. Generally speaking, long-term interest rates affect a bank's loan interest income, whereas short-term interest rates affect a bank's deposit interest expense. The relative interest rate, reflected in the shape of the yield curve, shows the trend of the banking industry's profitability. Currently, U.S. interest rates are near record lows. As of March 19, 2013, the 10-year Treasury bond yields 1.92%, and the 3-month Treasury bill yields 0.07%. This interest rate environment decreases interest margins for financial institutions, especially smaller banks whose profits come from retail and commercial banking businesses. Regulations on banks influence profitability by cutting income and increasing costs. Regulatory institutions such as the Federal Reserve and the Consumer Financial Products Protection Bureau place restrictions on banks and enforce strict capital requirements. The Dodd-Frank Act places restrictions on a bank's capital structure and transactions. The Third Basel Accord also limits a bank's profits from high leverage and risky products. Basel III forces banks to raise their current capital ratio, which adds considerable regulatory compliance costs and prevents banks from operating as efficiently as possible. Economic conditions affect a bank's ability to collect loans in the short run and affect industry growth in the long run. The economic factors that influence profitability include the GDP growth rate, the unemployment rate, personal income growth, consumer spending, and housing prices, among others. These macroeconomic factors drive the profitability of the banking industry. The barriers to entry are high. The commercial banking industry is highly competitive. Because the commercial banking market is relatively saturated, banks try to provide low rates, extended hours, and a comprehensive package of services to lure customers from competitors. Banks also attempt to differentiate themselves from their peers by providing customized services and by building brand values. Moreover, regional banks face strong competition from large national banks. Regional banks have a geographic advantage, whereas large banks are financially stronger and have more delivery networks. The financial risks of banks include liquidity risk and asset quality risk. To assess Iberia Bank's financial risk, we analyzed commonly used metrics such as loans to deposit, or LTD ratio, and the non-performing assets, or NPA ratio. We then compared Iberia Bank's results to those of the industry and its peers. A bank's liquidity is its capacity to meet various cash flow needs in a timely manner. LTD, the percentage of a bank's deposit available for loans, should be lower than 100% for a healthy bank. In addition, LTD should neither be too high nor too low. A high LTD indicates that a bank may fail to cover unexpected capital requirements, and a low LTD means that a bank may not be using assets in the most profitable manner. Iberia Bank has an acceptable LTD of 79.07%, indicating a healthy liquidity condition. The quality of a bank's assets, especially the loans it makes, is one of the most important indicators of a bank's stability. If a bank makes too many poor loan decisions, it is at risk of going bankrupt. We use the NPA ratio to show the asset quality of IBERIABANK and its competitors. IBERIABANK's NPA ratio is 0.69, which ranks second among its peers. Because non-performing assets are loans in jeopardy of default, IBERIABANK is considered a clean bank because it has an NPA ratio less than 2. Institutional and mutual fund ownership represents almost 95% of the company's shares outstanding. Over the last 12 months, institutions have purchased almost 3.4 million additional shares of IBERIABANK Corporation, while insiders have decreased their position slightly. As of February 28, 2013, IBERIABANK had a short interest of roughly 1.4 million shares, indicating a days to cover ratio of 8.9. This is relatively high compared with the market average. However, this graph shows that IBERIABANK's current days to cover ratio is on par with its historical average. In conclusion, the position changes and short interest ratio indicate a neutral to slightly bullish signal for IBERIABANK. To calculate IBERIABANK's 12-month target price, we use the price to earnings ratio, price to tangible book value ratio, and a modified discounted cash flow model. The price to earnings method of valuation measures the price that a stock trades at relative to its earnings and is an effective method to use when comparing companies within the same industry. The price to tangible book value method of valuation is an effective means to value a company's price in relation to its book value less intangibles such as goodwill. Instead of using operating or free cash flow for our discounted cash flow model, we chose to use net income as a substitute because cash is treated differently for a bank than it is for companies in other sectors. We assigned equal weights to each of these methods and arrived at an average price of $57. IBERIABANK has been able to grow rapidly over the last few years due to its many acquisitions. IBERIABANK has acquired several failed and healthy banks since 2005. However, as this graph shows, IBERIABANK's revenue growth has been very dependent on this acquisition strategy. While the company will still explore acquisition opportunities, we do not think there will be as many targets in future years due to the recovering U.S. economy. Therefore, management has been focusing on organic growth for the last couple of years and will maintain this focus going forward. The company has had strong organic growth numbers over the last couple of years and hopes this trend will continue. In 2012, IBERIABANK had roughly $1.1 billion in organic loan growth, with much of this growth coming from the Houston, Memphis, and Birmingham markets. Investors should focus on 3 key aspects of IBERIABANK when considering buying the stock. Over the past several years, IBERIABANK saw most of its growth from acquisitions of failing banks. However, now that the U.S. economy has recovered to some degree, the company is focusing on driving its revenue through organic growth. Also, IBERIABANK has been successful over the last few years of financial turmoil by taking a conservative approach to lending. In order to stay financially stable, the company will continue down this path of responsible lending. We believe this should be easy for IBERIABANK to do, considering its diversified mix of assets, its widespread geographic footprint, and its strong non-performing asset numbers. Finally, investors should monitor the regulatory changes IBERIABANK will face. There are many uncertainties surrounding the repercussions of the Dodd-Frank Act as well as the Third Basel Accord. This concludes our video presentation of IBERIABANK Corporation. On behalf of my team members, the Burken Road Reports program, and the A.B. Freeman School of Business at Tulane University, I hope that you found this presentation informative and helpful. Thank you for your time.